This LOS is explain and evaluate how impairment, revaluation, and derecognition of property, plant, and equipment and intangible assets affect financial statements and ratios. Presentation and disclosures. Overall, an analyst can use the disclosures to understand a company's investments in tangible and intangible assets, how those investments changed during a reporting period, how those changes affected current performance, and what those changes might indicate about future performance. Ratios used in analyzing fixed assets include the fixed asset turnover ratio and several asset age ratios. The fixed asset turnover ratio, total revenue divided by average net fixed assets, reflects the relationship between total revenues and investment in plant, property, and equipment. The higher this ratio, the higher the amount of sales a company is able to generate with a given amount of investments in fixed assets. A higher asset turnover ratio is often interpreted as an indicator of greater efficiency. Asset age ratios generally rely on the relationship between historical cost and depreciation. Under the revaluation model, permitted under IFRS but not under US GAAP, the relationship between carrying amount, accumulated depreciation, and depreciation expense will differ when the carrying amount differs significantly from the depreciated historical cost. Okay, this is just a review of some of the ratios. I throw this slide in from time to time. We've seen it many times if you've been going through all the videos. Okay, so just a review of some of the categories for ratios: activity, liquidity, solvency, profitability, and valuation. Okay, so if we're zooming in on fixed assets, we can see fixed asset turnover, which is going to be sales over average fixed assets. So that's a ratio that can be affected by certain transactions. Liquidity, not so much, because we're looking at current assets minus current liabilities. So not so much in this category. But when we go to our solvency, for sure, if we write down an asset, assets equals liabilities plus equity. We have seen when we derecognize or we have a write down, A will go down and E will go down, and that'll affect our capital, and that'll affect our debt to equity, or it'll affect our financial leverage as well. With regards to profitability, it's here where we look at the ROA because, again, certain things happening with regards to our transactions. A is affected, E is affected. So therefore, we saw some questions in the past about the future impact on ROA of a derecognition. Okay, and in terms of valuation, well, as we saw that depreciation effects and write-downs and derecognitions can affect our net income, so that's going to flow through to some of the valuation. So just a quick review on some of the common ratios used in financial analysis and how they fit into the reading on fixed assets, long-term assets. Okay, I just copied the sentence that ratios used in analyzing fixed assets include the fixed asset turnover ratio and several asset age ratios. It's these ratios here, or calculations, with regards to the asset age that I find almost all candidates and students need a little bit of practice on. We don't look at them too often. It's not so common, okay? So yet we can be tested on that. So let's look. The estimated total useful life for an asset is the time elapsed since the purchase plus the remaining life. So that's easy. If I've owned an asset for 3 years and the remaining useful life is 5 years, then our total useful life is going to be 8 years, okay? We're going to use remaining useful life later on in an LOS when we look at changing the depreciation estimates, okay? Changing the estimated remaining life is going to affect how we calculate our depreciation. Historical cost divided by our annual depreciation expense gives us an estimated total useful life, okay? So you can see this is CFA 101. We have 3 variables there. Given 2, can you calculate the third? So historical cost divided by the annual depreciation expense. Historical cost we can get on the balance sheet. Annual depreciation expense we get from the income statement. And that's going to give us our estimated total useful life, okay? And our historical cost is simply the accumulated depreciation plus the net plant, property, and equipment, okay? So estimates of average age and remaining useful life of a company's assets reflect the relationship between assets accounted for on a historical cost basis and depreciation amounts. Okay, some more formulas with regards to estimated total useful life, estimated age of the equipment, and estimated remaining life. So the estimated total useful life equals the estimated age of the equipment plus the estimated remaining life. So here, what we can do with this slide, I probably should put some equal signs like this because we're just rewriting that equation, but we're using some sub-calculations. So the estimated total useful life is can be estimated by the historical cost divided by the annual depreciation expense. The estimated age of the equipment can be estimated by the accumulated depreciation divided by the annual depreciation expense. And the estimated remaining life can be estimated by the net plant, property, and equipment divided by the annual depreciation expense. Okay? So again, these are some formulas that you need to memorize because given two, calculate the third, etc. So the average remaining useful life of a company's assets can be estimated as net PP&E divided by depreciation expense, although the accounting useful life may not necessarily correspond to the economic useful life. Okay, I think it's best to see these calculations through a little example, and you'll see how simple it is. A little bit confusing at first if you don't have a strong background in accounting. So assume that the asset initially cost $100, had an estimated useful life of 10 years, and an estimated salvage value of 0. Okay, so if that was straight line depreciation, 100 minus 0 divided by 10, we'd have an annual depreciation expense of $10. Okay, so each year the company records the depreciation expense of $10. So accumulated depreciation will equal $10 times the number of years since the asset was acquired. So in this example, when the asset is 7 years old, accumulated depreciation will be $70. Okay, so I've just copied those formulas again, but I've put in the numbers from our little example. So the age of the asset will equal accumulated depreciation divided by the depreciation expense. So again, here's the formula that we had from the previous slide. The estimated total useful life equals the estimated age of the equipment, 7 years, plus the estimated remaining life, which is 3. Okay, 10 equals 7 plus 3. So if I move these formulas down here now, the historical cost was 100 divided by the annual depreciation expense is 10. So we would have an estimated total useful life of 10. Again, accumulated depreciation divided by annual depreciation expense. At 7 years, our accumulated depreciation is $70 divided by 10. So we'd have an estimated age of the equipment of 7. And our estimated remaining life would be the net plant, property, and equipment. So it cost us 100, and we have accumulated depreciation of 70. So our net book value is 30. Okay, so that's our net PP&E. 30 divided by the annual depreciation expense of 10 would give us our 3. So a quick little example that shows you how we run through these simple little calculations with regards to estimated age of equipment, estimated remaining life, and estimated total useful life. So let's finish this LOS as we often do with a practice question. An analyst gathered the following data for a company in dollars millions. Gross investment in fixed assets, 31st December 2000, 2.8 million. At the end of December 2001, 2.8 million. So the gross investment in fixed assets, the book value didn't change. But of course, our accumulated depreciation went up from 2000, 1.2 million, to end of December 2001, 1.6 million. So the average age and average depreciable life of the company's fixed assets at the end of 2001 are closest to A, average age 1.75 years, average depreciable life 7 years, or B, average age 1.75 years, and average depreciable life 14 years, or C, average age 4 years, and average depreciable life 7 years. Okay, a pretty easy question when you get to the calculations, but you just have to remember and practice a little bit. The estimated total useful life equals the estimated age of the equipment plus the remaining useful life. That makes perfect sense. So we can estimate the total useful life by looking at the historical cost divided by the annual depreciation expense. The estimated age of the equipment we can calculate by the accumulated depreciation divided by the annual depreciation expense. And the estimated remaining life we can calculate as the net PP&E divided by the annual depreciation expense. So the only thing that you needed to do here, you can see that the gross investment did not change and the accumulated depreciation went up. So we know the annual depreciation expense then was 0.4, okay? 1.6 minus 1.2 gives us 0.4, because recall, we're going to debit depreciation expense, credit accumulated depreciation, okay? So that was the first calculation that we needed to do. Then again, if you just go down here, the rest has been given to us. So they're giving us some choices, but if we scroll down, you can see I did all the calculations just following the same pattern for the slides, and that's how you get good at doing CFA questions. It's just through repetition, through keeping the same patterns. So historical cost was given to us, that's the 2.8, divided by that annual depreciation expense, and we're going to have an average depreciable life, estimated total life, of 7. So 7 years is correct, okay? So automatically B can't be wrong. And then if I scroll to the next one, the average age, estimated average age, accumulated depreciation divided by the annual depreciation expense. We have our accumulated depreciation, it's the 1.6, and our annual depreciation expense 0.4. So 1.6 divided by 4 equals 4. So C had to be correct, okay? So I just finished it off here. The estimated remaining life would be the net PP&E divided by annual depreciation expense. The net PP&E is easy. That's 2.8 gross investment minus accumulated depreciation. 2.8 minus 1.6 gives us 1.2 divided by 0.4, and that gives us 3. So you can see one thing here to note to help you memorize is that the denominator is always that annual depreciation expense, okay? So our numerator changes for the estimated total life, historical cost. For the estimated age, the numerator is the accumulated depreciation total, and for our estimated remaining life, it's our net book value. So it just takes a little bit of practice, a little bit of memorization. You can see the denominator never changes. The numerator relates quite closely to what you need to calculate if you think about it, okay? And that's the last slide for this LOS. Thank you.